Ready to go. Hello, good morning, good afternoon. I think it's midday, so we'll get this webinar off and running. Thank you for tuning in today. Today I'm pretty excited to launch the next series of our Berkshire Hathaway investment here in Australia. 3 years ago, to much fanfare, we launched our first Berkshire Hathaway investment, which is an investment that has 100% exposure to Berkshire Hathaway, which is the first of its kind in the globe, which meets certain investment criteria, which I'll talk about today. So 3 years ago, we launched that first investment. We've since done 6 since, and we're the largest investment manager in Australia that has exposure to Warren Buffett's company himself, Berkshire Hathaway. So thanks for tuning in. Today's webinar should go for around 40 minutes. So my aim as the presenter is to educate you so you can make informed investment decisions. Likewise, to provide a general synopsis as to what Warren Buffett is actually doing right now, where he's investing his money, and in the hope that you can replicate his success. Since 1964, when Warren Buffett took over Berkshire Hathaway, that's right, 59 years ago, his annual increase in book values, that's the increase his company is going up by per year, the average return has been 19.7%. 19.7% on average per annum, which is a phenomenal result. It's impressive by itself, but when you aggregate that return, it's nothing short of mind-boggling. If you compound your money at that sort of rate for close enough to 50 years, then the return is a whopping 586,000%, which works out to be about 10 grand. If you invested 10 grand back in 1965, that would be worth almost $100 million today. So it's been a phenomenal investment vehicle for Warren Buffett and his faithful shareholders. One share for Berkshire Hathaway in the A-class shares is currently trading at $171,000 just for one share. So it's been one of the most successful investments of all time, and Warren Buffett has been quoted as being the most successful investor of the modern era. So a bit about us. JBG Structured Investments is an issuer of investments here in Australia, and Sequoia Asset Management is a group that we've teamed up with to launch the investment. Sequoia Asset Management is a team of investment managers with offices all across the country. So following on today's webinar, you have an opportunity to organise a free one-on-one investment consultation with one of the investment managers from both JBGSI and also Sequoia Asset Management. Just to give you a bit of an update, Sequoia Asset Management, they hold an Australian Financial Services licence, and given that, they are licensed to provide what is called general advice. So today, and moving forward, I obviously haven't considered your individual investment circumstances. My job is to provide education, and with education, that empowers you as an individual so you can become an informed, confident investor. So today's presentation is general advice, which means I haven't considered any of your personal circumstances. There's a few examples, so obviously a few assumptions I've made in those examples. I'll go through those assumptions so you can work out how much of an impact they can have on future returns. Likewise, while the average return for Berkshire Hathaway has been 19.7% per annum for the increase in book value, just because that's the past returns, that obviously doesn't mean it's going to happen in the future. In fact, over the last 12 months, the actual share price has risen close to 40%. So the last 12 months has been phenomenal. So about me, I've written a few books. Some of you may have already read those books. The first one is The JB Way. It's 118 pages long. I think there's around 150 quotes in there of Warren Buffett. My mum and my wife call me a Warren Buffett fanatic, and I'm obsessed with the bloke. And yeah, I probably agree with them. I've pretty much read every book that's been written about Warren Buffett. I had the pleasure only a few weeks ago of meeting the man himself. So he is my hero. And I think when it comes to being successful at anything in life, it's quite simple. All that you have to do is choose someone that has been successful at what you're trying to replicate, and then just copy them. When it comes to investment success, there is no better, no greater than Warren Buffett himself. Another two books I've written, which is under the Making Super Sexy series. which talks about how you can implement my investment philosophies using your superannuation. In fact, one of the biggest vehicles people use to invest in the Berkshire Hathaway investment that I've created has been their self-managed super fund. So if you already have a self-managed super fund, then that's great. You can take part in this investment inside of superannuation. If not, that's okay. You can do it in your own name or company, trust, all that sort of thing. In fact, you can gain exposure to Berkshire Hathaway in whatever entity you so choose. If you don't have a self-managed super fund, then by all means organise a meeting with one of the Sequoia asset management teams. They specialise in self-managed super funds. And again, they generally charge for their time, but given that you've come through the Knowledge Source portal and through this presentation, they're willing to give up their time for that initial consultation for free. So it's a good opportunity for you all. As a presenter or an educator, I've been recognised a few times. The first time was by this gentleman, Tony Robbins. Photo doesn't do it justice because Tony's actually standing about 2 steps higher than me. Well, not really. He is a big man. Tony recognised my skill set as an educator and as an investment manager back in 2003 when I was first invited to be the stock market expert here in Australia for the Tony Robbins Group. So it's good to be recognised by experts. But while I'm a bit of an educator, look, I'm a big believer in taking action. And while I'm an educator, I'm also, my main role is actually investment management as the director of JBGSI. Also met Donald Trump a few years back. So there's a few leading experts that I've had the privilege of meeting. I think the secret to success in life is to surround yourself with a team of experts, and hopefully you'll drift in their direction. Another person that I had the pleasure of meeting only a few weeks ago is the richest man in the world, Bill Gates. So Bill Gates attends the annual shareholders meeting for Berkshire Hathaway in Omaha every year. You know, I was sitting there in an auditorium of 40,000 people, and I looked down and saw Bill Gates in the front row frantically taking notes at anything that Warren Buffett said. I thought to myself, if Bill Gates is taking notes, maybe it's time I brought out a pen and a piece of paper. So it's good to network with phenomenal people. One thing that I did learn after spending a few days hanging out with Warren Buffett, Charlie Munger, and Bill Gates is that these guys are just human beings. They're just, while they're average blokes, they've got a huge bank balance. So each and every one of us can achieve success. We just have to be passionate and do whatever it takes to reach our goals. And we might not get to become the richest man alive like Bill Gates or Warren Buffett, but certainly if you're passionate about something and you dedicate your life to achieve it with hard work like Bill Gates or Warren Buffett does, there's no reason why you can't go on to reach whatever wealth creation or life goals that you have set out yourself. I've also been recognised as a bit of an expert, certainly when it comes to Warren Buffett. I'm asked by industry experts to talk, whether it's Sky News, I've been written about in various newspapers, CNBC, they call me up. Whenever anything happens to Berkshire Hathaway, I generally get a bit of a phone call as the go-to guy for Warren Buffett, and sometimes I take them up on that opportunity. So it's good to be recognised as an expert. But when I've analysed all these people that have been successful, I hang out with these guys. One question that I often ask them is, well, what is the secret of being successful? One of the most common traits is obviously that you have to be passionate and obviously work hard. If you don't work hard, then you're probably not going to achieve whatever goals you set out yourself. And that's your specialty. The other parts where the advice is that you stick to your core passion. With Bill Gates, that's sticking to managing Microsoft. Warren Buffett, you stick to your investment formula, which is investing. Tony Robbins, being an educator, a motivational guy, you stick to specialising on what your core competence is. For the rest of it, they're big believers in outsourcing it to experts. One of Bill Gates' biggest investments, apart from Microsoft, is in Berkshire Hathaway. And for me, when it comes to investing, you don't need to reinvent the wheel. You just have to outsource it to those people that have had a long-term track record of providing superior results to investors. And for me, there is none better than Warren Buffett himself, which is why we're here today. Another thing that I look at when I speak to different people or read various textbooks as to what goes on to be successful is that they have a clear and concise definition of what they're trying to achieve. They know exactly what their outcome is. They know what they want. This is a list that I've developed about what I want from an investment. And it's not stating that this is what you would be looking for in an investment, but certainly something that I'd be looking for from an investment. So what do I want from an investment? First thing I want is the opportunity to achieve high capital growth. I want the opportunity that for my capital that I invest today, that in 3, 5, 10 years, 20 years time, it's going to be worth a lot more than what it is today. So capital growth is my #1 priority as an individual. Second thing that I'd like is to have a high income capacity. So every year, the ability to drive a high income. Now, that's not my #1 priority because capital growth is #1 priority for me, but if it's got the capacity to generate a high income along the way, then I'm less reliant on the market increasing, or I'm taking less risk in the last few years of the investment. If the investment falls like a lot of things happened in the GFC in 2008, if I've been able to harvest some growth along the way by taking some income, that's putting some money in the bank, which again enhances return but also reduces the overall risk. So #1 is high capital growth, #2 is a high income capacity. This is what I'm looking for in an investment. This is my top 10 things. Also, while I want high capital growth and high income, I also want it to be a relatively low-risk investment. I don't want to be doing advanced trading schemes that have got the capacity of losing not just my total investment, but more so. I want it to be considered somewhat safe. And when you look at Warren Buffett, he will not invest in anything unless there is a margin of safety, unless he has a safety net in place to minimise the loss on the downside. And I'm the same. So I want an investment that offers a safety net just in case the investment falls in value. While everything looks like it might be an outstanding investment opportunity for the next 12 months, 3 years, 5 years or 10 years like Berkshire Hathaway does in the current market, there is a chance of it obviously going wrong and falling in value. So I want to implement a safety net to ensure if that does happen and I'm wrong, as an investment manager for my money, likewise all of my investors' cash, it's somewhat protected. I want the ability to borrow, not just to borrow money, but also at cheap interest rates. At the moment, you can borrow to actually invest in Berkshire Hathaway through our investment of 4.95%, which is fixed for 3 years. So when you look at where we are today, it's the first opportunity that I know of in my time as an individual investor. Likewise, for the last 50 to 100 years of studying investment markets, where we've been presented with asset classes that are very cheap, yet with interest rates almost at all-time lows. Rather than talking about Berkshire Hathaway, if we look here domestically at our share market is trading about, it needs to go up about 40 or 50% to get back to those pre-GFC highs. So it's trading what I would believe at a very cheap price, at a discount to the rest of the markets. The Dow Jones has gone on to be at record highs or close enough to it in the last few weeks. The FTSE, the same sort of thing. Japan a few weeks ago was at pre-GFC highs. So a lot of the economies and a lot of the share markets of the world have gone on to great strength, if not all-time highs, yet the Australian share market has lagged the rest of the world, despite being an envy of many economies. For me, that represents a great buying opportunity. Things are cheap. And the secret to making money on the share market or making money in any asset class is to buy when prices are low. Warren Buffett states that you buy when there's blood on the streets. You've got to make sure that that blood isn't your own. So look across the globe at where I think undervalued investment markets are. Here in our back door, our own backyard, it's very cheap. Companies like Berkshire Hathaway, while it's trading at $170,000 a share, I believe it's very cheap. In fact, it's not just me who thinks it's cheap, but Warren Buffett himself. At the AGM, I was at the annual shareholders meeting in Omaha just a few weeks ago. Warren Buffett actually announced that he's buying back Berkshire Hathaway shares. So Warren Buffett could be presented with anything. He can invest his money anywhere across the globe. Yet Warren Buffett is choosing to buy back Berkshire Hathaway. So he's instituted a share buyback at or below 1.2 times book value, which is below where I believe it's trading at the moment. So I think that provides somewhat of a backstop to the share price, and it's obviously worth noting that if Buffett only buys when he's given a margin of safety, he likely believes that the current share price of Berkshire Hathaway undervalues the company. So personally, look, I love the Australian share market, and then I look at replicating others. if Warren Buffett is happy to buy Berkshire Hathaway, and that's where he's putting his money as the most successful investor pretty much of all time, then I'm happy to back him as well. So that's why we put this investment together. Likewise, the last 6 is that we want to invest where Warren Buffett's investing his money. We want Warren Buffett to be controlling our investments. Warren Buffett is the chairman, chief investment officer, and also the CEO of Berkshire Hathaway, which is where I'm happy to put my money, whether it's in super or outside of it. Certainly, if Buffett's willing to put his money there, that's a fair enough for me. If a company CEO and chairman is backing his own stock, then that's a good indication it's time to buy. So we're looking at buying when there's blood on the streets or when prices are trading at a discount. If Buffett is saying Berkshire Hathaway is good enough for his money, then it's good enough to mine. Then we want to look at borrowing at low interest rates. You can borrow the full amount at 4.95%. In fact, you can borrow 100% of the investment. All you do have to pay up front is 3 years of interest, so 4.95%, and then there's a currency hedging fee of 1.1%. To buy shares in Berkshire Hathaway, we've also got to turn up to the New York Stock Exchange. They don't accept our play money, so we convert it to US dollars, and we want to make sure if we're borrowing the full investment amount, we've got enough to pay back the Australian dollar loan that we're taking out. So it's hedged against any currency movements. However, we do pick up a gain if the currency does fall on any gain. So if the Berkshire Hathaway or our investment goes up 30%, Australian dollar goes down 10%, let's say, then we'll make 33. If it goes against us by 10%, though, it only dilutes our return by 10%, so it'll go from 30 down to 27%, as an example. I'm not saying that that'll be the returns, so just giving you a bit of an example to highlight how the currency can work in our favour while the principal investment amount is hedged. It's self-managed super fund friendly, so if you've got a self-managed super fund, then you can take advantage of this opportunity. If not, again, I invite you to organise a one-on-one meeting with the guys at Sequoia to discuss whether or not a self-managed super fund is suitable for you. But that's not the only vehicle you need to invest in. You can invest in your own name, which plenty of people are doing in the last 6 years. When I'm looking at investments that meet my criteria, I want it to be simple, something that I don't need to go spend 7 years at university to understand. And sometimes simplicity is the most form of, or the best form of sophistication. Simple is simply just choosing the best investment managers around the globe, like Warren Buffett, and putting your money there. That's a good starting point as to why I believe this is simple. Then I want it obviously to be managed and backed by someone who has a long-term track record of providing a superior return when the market goes up and also when the market falls in value. Then the fees that are associated with the investment to be aligned to performance. They're the sort of top 10 things that I look for in an investment as an investor. So first and foremost, when you look at the secret of success, what I've learned from the world's most wealthiest people and investment managers is first and foremost you got to know what you want. And that's a list of what I want when it comes to investing. And then something that won't take up too much of my time. I don't want to be spending hours a day managing my investments. As an investor, I'm lucky enough, of course, that is my core competence. You can run on my coattails. So it's just a matter of looking at investing and then 3 years' time, basically looking back to make a decision how to move forward. In the meantime, you concentrate on what you're good at, whether that's running your own business, in your own career, managing a family, or playing golf, if that's what you want to choose to do. So secrets to investment success, know what you want. So I've just gone through my list there, and I encourage everyone to develop your own list as to what you're looking for an investment. Only once you know what you're looking for will you find what you're searching for. And then prioritize the list. Rank them in order of what's most important to you as an individual. If you're looking at trading off 2 investments, you can do it from a position of strength rather than just going from gut instinct, or whatever buzz strategy there is now, or buzzword, whether it's options, warrants, CFDs, all those trading mechanisms that have been buzzwords in the past decade, yet I haven't met too many people that have been successful investors trading those tools. So we know what we want. The second step is to model someone who has already been successful at what we're trying to achieve. It's very easy to look at investing and look at modeling someone who has already been very successful. And that is Warren Buffett. We'll choose the most successful investor of all time. Warren Buffett is, I think he's ranked the 3rd wealthiest man alive at this point in time. Number 1 is Bill Gates, who is one of his good mates. Number 2 is Carlos Slim, who's a Mexican telecommunication tycoon, and Warren Buffett is number 3. So if I'm looking at trying to replicate those people that have gone on to be successful in the past, and with Warren Buffett, he's been successful for the last 50 years, where the average rate of return has been 19.7%. As I said, 10 grand back in 1965 would be worth almost $100 million today. I'm happy to jump on his coattails and model him as a successful investor. This is Warren Buffett. Warren Buffett is 82 years of age and is very healthy, looking at him there. This is the difference between investing in the share market, being the S&P or the US share market as measured by the S&P 500, and Berkshire Hathaway. Now, many stockbrokers or stock market educators, investors would state that the share market has provided a superior return than any other asset class that exists, above property, above fixed interest, certainly above cash. Well, if the market provides a superior return, then Berkshire Hathaway is phenomenal. $1 invested in the US share market back in 1950 would be worth around about $750 today. So that's $1 would be worth $750. However, $1 invested in Berkshire Hathaway shares would be worth almost $1 million today. It is those sort of returns that has meant Warren Buffett has gone from basically a man of very little assets to being the third wealthiest man alive. And many people thought, or that are successful, generally hold their cards close to their chest in that they don't like to relieve too many secrets. Well, Warren Buffett's secrets have been known for decades. Yet many people try to replicate it. Very few are smart enough just to buy his shares. So Berkshire Hathaway, this is the company that Warren Buffett took control of back in 1964. Back in 1964, it was a textiles company. Now, though, textiles are long gone. Berkshire Hathaway is simply a multinational holding company. That is, it's an investment vehicle that holds investments in various other companies. Like, for instance, Coca-Cola. Coca-Cola, they own just under 10%. It's the largest shareholder of Coca-Cola. American Express, they own around 14%. Wells Fargo, United States Bank, they're around 10%. They own about 10% of IBM. Heinz, what other ones? Dairy Queen, Clayton Homes. They own various insurance and reinsurance companies. You put those all together, it just owns those companies. It actually only employs just over 20 direct people. And they take up one floor in Omaha, Nebraska, where the company is actually managed. So while there's only 20 people, they obviously employ a lot of people indirectly with their large holdings. They are Goldman Sachs, Bank of America, they have large shareholdings in General Electric. So it's a big company that owns shares in a lot of different firms, whether they're listed on the share market or they own companies entirely that are unlisted. A bit like Lubrizol or Burlington Northern Santa Fe, to name a few that are unlisted. If you look at Berkshire Hathaway, it is currently ranked as the 4th largest company in the world, behind ExxonMobil, Apple, Google, and Microsoft is actually number 5, being a little bit less in sheer size than Berkshire Hathaway. So it's a big company. In fact, if you look at Australia's largest 2 companies, it is BHP and also Commonwealth Bank of Australia. If you add those 2 together, their size is still smaller than Berkshire Hathaway, just to give you a bit of an idea and context into the sheer size of what Berkshire Hathaway is. The average annual growth in book value of Berkshire Hathaway has been 19.7% per annum for 48 years. Every month of all the dividends or all the revenue and income that is generated from Berkshire Hathaway holding companies that it holds, it produces around $2 billion of income each and every month, which is phenomenal. So there's a few of the companies that it owns: Heinz, IBM, General Electric, Gillette, Goldman Sachs, Bank of America, American Express, Mars. So what Warren Buffett does is he looks for an investment that is a solid company with a solid brand, and there's a high probability of revenue and profit being anticipated for the next year. He talks about Heinz, for instance, that he understands exactly or very accurately he can determine what future cash flow and future profits is going to be generated. Because despite what happens to the overall economy, tomato sauce sales is still going to be quite strong. Gillette, the shaving company, he says that irrespective of what happens to the economy, he knows tomorrow, irrespective of what happens overnight, that 50%, if not more, of the population are going to wake up in the morning and need to shave. So he buys stable businesses, businesses that he refers to as being elephants in sheer size, so big companies. But he'll only buy them, this is what he said at the AGM a few weeks ago, he'll only buy them when they're lying on the operating table. What I've learnt in studying Buffett and his genius is that he's one of the cheapest men alive as well. Talking to Susan, his daughter, she revealed that Warren actually drives a hail-damaged car. So the third wealthiest man is driving a hail-damaged car. The reason he bought a hail-damaged car was because it was cheaper. He is cheap. However, there's two ways to become wealthy. That is to accumulate a lot of money, and the second one is not to spend too much. Warren Buffett likes to accumulate a lot of cash. This is a few photos that I took at the AGM. As you can see on the left, there's 40,000 people that turn up for a weekend to hang out with Buffett and Charlie Munger. 40,000 people there for the formalities of the AGM, which was for 7 hours. Charlie Munger and Warren Buffett sat in front of the audience and answered questions from shareholders. Likes of Bill Gates there on the right. That was a photo I took in the morning where they were in a newspaper tossing competition, Bill Gates and Warren Buffett. Warren Buffett started his days at 12. He was a newspaper delivery boy, and actually at the age of 12 he filed his first tax return where he claimed depreciation on his push bike. At the age of 13 he bought a few pinball machines and he put them in the barber shop and a few different locations where there was high traffic flow in Omaha. 12 months after establishing that, he accumulated enough money from that business to buy his first property. His first property was a farm at the age of 14. So he's had an interesting life and continually continues to do so. That's me. You look there at the left, the only thing that you could drink at Berkshire Hathaway conference was Coca-Cola. The reason why is that they own 10% of Coke, so why offer anything else? At the right, that's where my seats were for the official AGM. You can see Warren Buffett and Charlie Munger in the background. It's me, Warren and Charlie on the left, and on the Sunday they have more of a social day with all shareholders. They had bridge. You can see Bill Gates there playing bridge. You have ping pong. There's Bill Gates and Warren there on the left playing ping pong. And they also have a fun run, the Buffett Classic, which is a 5K fun run. And Warren Buffett turns up in his own car, driving his own car, fires the gun, and you run 5Ks, and at the finish line he was there to hand out the trophies. In his own tracksuit, no security, driving his own car. That's his house there on the left with Jason Bibby, the state manager of the Secura Asset Management team down in Victoria, and myself in front of his house that he's had for the last 50 or 60 years. So it's just an average house just off the main road. Warren Buffett states it keeps him warm in winter and cool in summer. What else would he like? So despite his huge wealth, he lives in a very modest house. And that's the office that they have one floor of there in Omaha on the right. So the Warren Buffett way. Warren Buffett, rules to investment success is never lose money. Rule number 2, never forget. Rule number 1. That is how important it is. And if you look at the annual increase in book value for Berkshire Hathaway over the last 50 years of Buffett running it, it's actually only been 2 or 3 years where there's been a negative result to investors. The reason that he never loses money is that he's able to negotiate very attractive terms, and generally, certainly in today's day and age, every investment that he does make generally has a huge safety net. That is with the Goldman Sachs trade. Like, he invested $5 billion in Goldman Sachs. Many people thought he bought what was called ordinary shares, so just shares on the share market. What he did actually do is bought preference shares. Preference shares mean that it makes no difference what happens to the underlying share price. He's provided Goldman Sachs stays in business, is entitled to get that $5 billion back, which was over a 5-year period. He negotiated to be paid 10% per annum income on that investment. And if Goldman Sachs wanted to buy it back, they would have to pay a 10% premium. 3 years later, Goldman Sachs wanted to buy it back. and he made on the $5 billion investment around $3 billion in total in income over that 3-year period. He also then negotiated a free attaching option, which gave him the right to convert his $5 billion investment into ordinary shares. That was for free. He still holds those, and they're worth around $1 billion at the moment. So with that trade, Warren Buffett gains pretty much no risk on the downside, provided Goldman Sachs didn't go broke. And he was pretty confident that wasn't going to happen because he just wrote a check out for $5 billion to the company. Yet he enjoyed all the pleasure and upside of that share price, plus ongoing income. So when the official US interest rate is basically at zero, he's been able to be paid 10% per annum. Now, that's a phenomenal trade. Get all the upside of the share price, pretty much none of the downside, and 10% income each and every year. If you want access to those deals, then you need $5 billion in cash. That's what Warren Buffett waits for. Goldman Sachs was on the operating table. He waits for outstanding companies, big elephant-sized firms, when they need cash. And he knows that most companies will need cash in the future because, as he states, when the tide goes out, he finds out who's been swimming naked. If you don't have $5 billion, then that's okay. It's an easy way to get access to those deals. Simply buy Berkshire Hathaway shares. Because that money and that investment that he did was in Berkshire Hathaway, likewise most of his investments. So Warren Buffett, he never loses money because he buys stock. They offer high growth potential. He buys when there's blood on the streets and they're trading very cheaply. Secondly, he buys it with a safety net, like negotiating deals with the preference shares similar to Goldman Sachs. I mean, people thought that was a once-in-a-lifetime opportunity, but 3 years later, Bank of America came turning up at the door and said, we need cash, and Buffett was basically able to negotiate exactly the same terms. General Electric, Heinz, all these investments that he's made over the last 5 years, and there's been about $150 billion worth of investments he's made in the GFC, or since the GFC, have all had very, very similar investment characteristics to that Goldman Sachs deal. So if you didn't understand exactly what I said, don't worry. All you've got to realize that it's a great trade, and the way to gain exposure to run on Buffett's coattails is to gain some form of exposure to Berkshire Hathaway. Warren Buffett also states is that you look at market fluctuations as your friend rather than your enemy, profit from folly rather than participate in it. That is, when the market has a huge fall, or you read headlines like 30 billion wiped off Australians' retirement savings, you see the market plummet. Warren Buffett doesn't look at that as a selling opportunity because the market obviously has already fallen. He looks around to see if there's any outstanding buying opportunities. So to actually make money on the share market, I think here in the Australian share market, it's around 86% of investors lose money simply because they buy when it feels good. They obviously pay a huge price for that certainty. But uncertainty is the friend of an astute investor. When the market plummets, and here in Australia the market has had a big pullback, many people were waiting for that pullback in the last 2 weeks. A lot of people were jumping over themselves to invest only a month ago. The market was at 5,250 points. Now it's down over 10%. There's not much volume at all. So the secret of making money on the share market is just to do the opposite of everyone else. When everyone else is selling, that's the time to be buying. When everyone else is buying, the market's really high, maybe that's time to start taking some profits. That's what Warren Buffett means when he says look at market fluctuations as your friend rather than your enemy. So his investment philosophy, buy growth assets, being property and shares. He believes in productive assets. He's not a big believer in gold. He doesn't state that gold's a bad investment, it just doesn't meet his investment characteristics. Then he states he's adopted a focused investment philosophy, which has actually been hard for him to implement of late simply because of his sheer size. And number 3 is never lose money. So secret to investment success, we know what we want. We've developed a list. I encourage you, if you haven't done so, to develop a list of what you're looking for in investment. Model someone who's already successful. And to model someone like Warren Buffett, you need $5 billion to negotiate those sort of terms. Now we need to obviously develop our own investment philosophy. Today I'm making that very easy. The investment philosophy is to buy growth assets like Warren Buffett, like property and shares. They've got the capacity to provide high capital growth over the next 3, 5, 10 years. There's the Australian share market. As you can see, it started in the bottom and gone to the top right. If you believe in population growth, you believe in systems becoming more and more efficient, then the markets will generally go up because profit usually increases. As you can see on that chart, there's black text. I'm not too sure if you can read it. I can't from where I'm sitting. You don't need to know what's caused the market to fall. That goes back down to 1900 to 110-year history. All you have to look at is that there's always a reason to be fearful. There's always a reason for the market to fall. But every time it does fall, that should be considered a buying opportunity. So my investment philosophy, buy growth assets. Second one is to adopt a focused investment philosophy like Warren Buffett. So wait for outstanding opportunities, and when they come around, have a big swing. Diversification may preserve wealth, but concentration builds it, which is a quote by Warren Buffett. And the third part, to reduce risk. While we don't have the capacity to negotiate exact terms like Warren Buffett, we need to implement a safety net, so we look at buying insurance. Insurance and shares is simply a put option. It gives you the right but not the obligation to sell your shares at an agreed price. So what we're looking at here is actually how to maximise returns and minimise risk. Now, I don't have time, just looking at the time, we're flying through it. I won't go through this example for Westpac. I'll go straight to the example as to how we can go about buying Berkshire Hathaway and provide a safety net and capital protection on the downside. Briefly, we buy 10,000 shares at Westpac at $30. We then buy a $30 put option. This is back in 2007. Then we get dividend income that offsets some of that premium. As you can see, the share price plummeted. When that happened, we just get our 300 grand back. So we sell it at $30. So if you want to know these examples, by all means, put your details into the question section, your email, your phone number. We'll get in contact with you and send you a copy of my book, which is where they all come from. I want to get straight to Berkshire Hathaway. So to invest in Berkshire Hathaway and to adopt a safety net like Warren Buffett does, you need to be able to buy a minimum of 100 shares to buy a put option, because one put option contract covers 100 shares. If one share is trading at $170,000, to implement my investment philosophy, which has been modelled off Warren Buffett, you need 17 million, which is a pretty big amount of change. So rather than needing to turn up with 17 million and then buy a put option just in case Berkshire Hathaway share price halves, and it did, it fell 50% in the height of the GFC. Rather than doing that, what we've done is put together an investment. It's a capital protected structured investment that gives you 100% exposure to JBG structured investment, which we then go on invested in Berkshire Hathaway. There's no other thing invested in it. It's 100% exposed to Buffett himself. Here's an article. I just want to cover a bit of the article because it's not just me that believes in Berkshire Hathaway. There's an article written by the guys from Motley Fools, which many of you may be quoting. There are two elements to any successful investment. This is straight from the article. Finding a great business and then paying a reasonable price based on assessment of that business's future. As far as quality businesses and outstanding track record go, they don't come much bigger or better than the company run by the world's fourth richest man, Warren Buffett. So much so that since Buffett assumed control of the company in 1964, the book value has increased by 19.7% per year on average. That's impressive by itself, but the aggregate return is nothing short of mind-boggling. If you compound your money at that rate for almost 50 years, the return is a whopping 586,000%. That's not a typo. By contrast, the S&P 500 is up on average 9.4%, which is still impressive, but well short of that of Berkshire Hathaway. At the current price, there is plenty of reasons to believe Berkshire Hathaway is one of the easiest investment decisions you can make. Berkshire is a strong business with loads of cash on its balance sheet, a very large, stable, successful and profitable subsidiaries, a listed portfolio of some of the world's best businesses, and two proven investment managers, plus Buffett himself. You'd expect to pay a significant premium for that combination, but the kicker is Berkshire Hathaway is available for only slightly more than 1.2 times book value. That's a reasonable valuation for an average business and an attractive one for a good business. In my book, that makes Berkshire, which is an outstanding business by any measure, available at a very attractive valuation indeed. Buffett himself has instituted a share buyback at or below 1.2 times book value, providing something of a backstop to the share price. And it's worth noting that Buffett only buys when he's given a margin of safety. He likely believes that price undervalues the company. Long-term investors looking for a collection of strong, solid businesses with a moderate competitive advantage and good growth prospects, a Fort Knox balance sheet, friendly management, available at an attractive price, need look no further than Berkshire Hathaway. That's a pretty good testament as to why so many people believe in Berkshire Hathaway and Warren Buffett himself. As I said, $1 invested in Berkshire Hathaway would be worth almost $1 million today had you invested back in 1950. While that's been the case, the last 3 years has actually been one of the worst 3 years investment period of all time for Berkshire Hathaway and Warren Buffett. So while it's made money, while the share price has increased in value, the actual return has been dismal in comparison to the previous. When I say dismal, let's look at an example and see what sort of return you would have made over the last 3 years, even though it's been the worst 3-year period in history for Warren Buffett. So as Peter and Ann, they've been frustrated with the poor performance of their super fund. They actually decided to set up a self-managed super fund, and then they're going to invest $187,000 in total to gain $1 million exposure to the Berkshire Hathaway JBGSI investment. They know that they're looking to reduce fees in their self-managed super fund. They're taking control of their super. They want exposure to Buffett. They understand the secret of success is just to simply put their money with the people who have got the long-term successful track record. They know exactly what their downside risk is. While they've got $1 million exposed, and this has given them the capacity to borrow $1 million in their super fund, they only had to outlay $187,000. They love leverage, and that's how they've accumulated so much wealth in the past. And they like the low interest rate being 4.95%. So they buy at $1 a unit. They invest $1 million. They borrow $1 million through a limited recourse loan. Their total outlay is $187,000. Nothing else further to pay. That's the upfront establishment fee, upfront interest expense, and all the currency hedging fees. Value at maturity was what, $1.26 million. They paid off the loan, which meant that they've made $260,000 close enough. So the return on the investment is 42.83%. That's the return on their outlay, their at-risk capital. So while the last 3 years has been one of the worst 3-year periods for Warren Buffett himself, the actual return on their investment has been almost 43% over the last 3 years, which makes this investment one of the most successful investments in Australia over the last 3 years. A lot of people give me credit for that, but hey, all that I've done here is pick the most successful investor of all time and then back to him 100%. If he's provided consistent returns over the last 48 years, then I expect the next 3 years to be solid. And the worst 3-year period, our investors have made 43% return on their money. So, well, Peter and Ann have taken control of their super. They could have invested in their own name. They've got $1 million exposure to Berkshire Hathaway, or our investment linked to Berkshire Hathaway. They've turned $187,000 into $267,000, which is a 43% return of their money over the last 3 years. It's a good question. Over the last 3 years, ask yourself, how has your super fund performed? Now, it's not rocket science here. All that we're choosing is Warren Buffett and then back him 100%, nothing else. So while past performance doesn't necessarily equal future performance, look, if it's been the worst 3-year period in history for Berkshire Hathaway with Warren Buffett over the last 3 years, even if it is just as bad for the next 3, you're making a 43% return on your investment. I'm pretty happy with that. There's not too many banks that can provide that, or super funds. Another example, here's John. He saved $18,700. He's a high growth investor. He doesn't have $170,000 himself to go buy one share in Berkshire Hathaway, so he's got a bit of a problem. He loves Warren Buffett, but he just doesn't have the outlay required to go buy one A-class share. So he meets one of the guys at Sequoia. They sit down with him, talk to him about the investment, and he decides to invest that $18,700 and invest $100,000 into our investment. So he borrows the $100,000. He invests his $18,700, which is all the prepayment of costs. He knows he can lose that $18,700, but he's a high growth investor. He's comfortable with that risk, given that he's got $100,000 exposure to our investment. So he's taking control. He's got exposure to Buffett. He knows what he can lose up front. He can't lose any part of the $100,000 because of the limited recourse loan. He's young, so he loves leverage. Low interest rate, 4.95%. He's interested in. The outcome, he invests, got $100,000 invested. His outlay is $18,700. So what he's made $26,000. So his return on investment is 43%. Again, a phenomenal rate of return. So that was the investment that we did 3 years ago. Now, because of that success, we've come out with a new investment. The new investment gives you exposure to Berkshire Hathaway for the next 3 years. Now, we invest in a week's time. We then implement a safety net, being capital protection. That's why John and Peter and Ann could borrow 100 grand and they could never lose that 100 grand, is because it's capital protected. So it's like insurance on shares. You can borrow 100% of the investment amount. In fact, you have to. You can do it in your super fund if you wish. The interest rate's 4.95%. There's a currency hedging fee of 1% for Berkshire Hathaway only. In fact, you can do this structure for the Australian share market as well. There's no currency hedging fee. You can borrow the full amount. The maximum outlay is 4.95% per year. You prepay 3 years of interest up front. There's no currency hedging fee for our ASX 1. We're going to be paying a contingent coupon of up to 10.8% in year 1 and 2. But as I said previously, it's sort of like harvesting the growth as the investment goes. But we do need the performance. Of course, Berkshire Hathaway doesn't pay a dividend. We need Berkshire Hathaway share price and the investment to go up. If it doesn't go up, then there is no coupon. So they're not guaranteed. You get exposure to the currency just on the gains only. So with an investment example, you outlay the unit price is $1. Let's say you invest 100 grand. The minimum investment amount is $50,000 borrowed, which requires an outlay out of your back pocket of $10,000. So you've got 10 grand, whether in your self-managed super fund or in your own name, you can get a 50 grand exposure to our investment. So that's the entire upfront cost for the full 3-year period, and 20 grand thereabouts is the maximum amount you can lose. So you can lose your outlay, but remember your 20 grand is the prepayment of all costs for the full 3-year period, yet you've got 100 grand exposure to our investment and the upside capital growth on the $100,000 investment. So that's an investor example for 100 grand. One of the questions that just came up, it was about the minimum. Just to confirm, the minimum investment out of your back pocket is $10,000 thereabouts, and they'll give you a 50 grand exposure. There is no maximum. That's another good question. So the key risk, there's no guarantee the investment will go up. While Berkshire Hathaway has gone up, there's a book value 19.7% per annum on average for the last 50 years. There's no guarantee that it's going to be the case moving forward. We do need it to go up by more than the interest expense to break even. The capital protection only applies at maturity, which is in 3 years' time. Every 3 months you can redeem, but it's more of a profit-taking mechanism. The return is affected by the performance of Berkshire Hathaway and volatility management, which is an advanced investment management technique that we've built into the investment. Counterparty credit risk, the person providing the capital protection, the loan, is an investment-grade bank. So your counterparty is the likes of the largest banks in the world. Your downside, if you look at that example before, is the 20 grand, 20,350, but you've got 100 grand exposed to the investment. So that's the maximum amount you can lose. You prepay all the expenses for the full 3-year period up front. So it's a high growth investment. The investment is linked to not just the share market, but one stock, being Berkshire Hathaway itself. Why choose any else when Berkshire Hathaway has been the most superior investment vehicle of all time, is my belief. There's 4 risk management strategies built into the investment. 1 is the capital protection. 2 is the limited recourse loan. 3 is the harvesting of the growth as we go along. And 4 is dollar cost averaging. Again, it's a pretty good opportunity to sit down with the guys at Score Asset Management to go through those in detail. You borrow 100%, 4.95%. You can do that and borrow the entire amount for a self-managed fund if you've got one. You prepay 3 years of interest up front plus the currency hedging fee. Every quarter you can redeem, and the term is about 3 years. So you look at secrets to investment success. First and foremost, I said, it's to know what you want, to develop a list of what you're looking for in investment. For me, that was an investment that has the opportunity to provide high capital growth potential. For me, I don't need to look any further than the most successful investment vehicle of all time, Berkshire Hathaway. High income capacity, this has got the capacity, which is contingent on the performance of the underlying investment, to pay out up to 10.8% in year 1 and 2. Low risk, well, I've got 100 grand investment, and the maximum amount I can lose over a 3-year period is $20,000, being my outlay up front. It's got a safety net, that's been capital protection, just in case we're wrong. While the returns have been 19.7% on average for the last 48 years, there's no guarantee that there's going to be any return in the future. In fact, Berkshire Hathaway could fall in value. While I think it's a low probable event, if that does happen, we've got that capital protection in place, which only protects the loan amount. You borrow at 4.95%. You can do that inside of your self-managed super fund. I believe it's simple. You just got to decide whether or not you want to back Warren Buffett. This gives us exposure to implement a investment strategy that involves capital protection and 100% borrowing on the investment without the need to have the 170 grand outlay just to buy one of Berkshire Hathaway's A-class shares. And then simply you decide to invest, then you decide every quarter whether or not you're going to continue to hold or sell the investment. In 3 years' time, if it's up, you make money. If it's down, well, you've got the capital protection to walk away from the investment. It's backed by someone who has got a long-term track record, not just someone, but the person that is the most successful at investing of all time, Warren Buffett. Now, for my fees, for JBG, SI and Sequoia Asset Management, they take a 2% application fee up front, which covers the cost of putting the investment together. So it's a cost recovery. It's just a one-off fee. And where we make our profit is through a 10% performance fee. So if we make you a lot of money, we make 10% of that. If we make you nothing, then our profit, our performance fee is nothing as well, which for me, I believe is what we deserve. If we don't add any value, then we shouldn't make any profit either. I get frustrated when super funds make billions and billions of dollars and provide no returns to investors. In fact, we've won a few awards in introducing ethics and integrity back into the markets. We're aligning our interest with that of yours as an investor. And something that won't take up too much of your time. The next step is basically to organise a one-on-one meeting to go through the investment. If you've got any questions, specifically with the person that's helped put together the investment, those guys from Sequoia Asset Management. It's the secret to success. To investment success, know what you want. They were my list. High growth potential, high income capacity, a safety net, investing with the world's most successful investor being Warren Buffett, something that's not going to take up too much of my time, something that is simple. Those all criteria are very important to me. Liquidity, so I can redeem every quarter. So we know what we want. We've modeled someone who's successful as Warren Buffett. We've developed our own investment philosophy. We've created investment. We're giving us 100% exposure to Berkshire Hathaway, and we've got a safety net and capital protection just in case we're wrong. Many people said that what we're doing is a Warren Buffett on Buffett himself. Of course, we've got capital protection and similar characteristics to what Warren Buffett negotiated with Goldman Sachs. We've just achieved them for Berkshire Hathaway on Buffett stock himself. The fourth part is to take action. Look, I respect and applaud everyone for tuning in today to learn about investing, learn about how you can gain access to the world's greatest investment manager of all time, and how you can gain direct exposure to that. But obviously, knowledge is only powerful if it's applied. If you do nothing with the information that you gain in any seminar or any education format, then that knowledge is wasted. What you do need to do is take action and do something with that information. We're going to make it pretty easy. The next step, as I said, is basically just to organise a one-on-one meeting with the guys from Sequoia. And when you're registered, all that we've got is your email address. So if you'd like to organise one of those free investment consultations, then by all means put your details into the questions section. I think I've worked out that's the only way I can collect them. So put your name in there, what state you're from, and your best phone number. That way we can get in contact with you as soon as we can, because the investment does close. It closes in a week's time. We raise the capital. We raise the capital this financial year. We choose the capital protection in 3 years' time. So you do need to organise that meeting ASAP. So please put your details in the question section, and we'll give you a free one-on-one investment consultation. Likewise, if you want to talk about self-managed super funds or anything else, they've decided to do that free of charge for everyone that's tuned in today. Also, how we grow our business and keep our fees extremely low where they're only aligned to performance is we encourage referrals. We will be having a webinar again tonight at 8 o'clock. Simply go to the site that you registered for this one today. By all means, recommend as many friends as you can, or those people you think that would like further information on how they too can grab the coattails of the world's most successful investor. So thanks for tuning in. As I said, knowledge is, and investment success is very simple. You simply invest where those people are investing their cash. While we're exposed to Berkshire Hathaway, Warren Buffett came out just a few weeks ago. He said the company that he's willing to buy with his own money is Berkshire Hathaway himself. So if he's buying the Berkshire Hathaway, then I'm happy to gain exposure to that company as well. We give you exposure through our structure to capital protection, to 100% borrowed money, borrowing money at a cheap rate being 4.95%, and something that you know day one what the maximum downside risk is. So I might open for questions. We've gone for 55 minutes. Sorry for going a little over time, but if you have any questions, by all means, put it into the question section, and I'll endeavour to bring that up now to answer them. Just bringing up the screen now. Again, to register for those free investment consultations, by all means, please put in the question section your name and your phone number, and the guys from Sakura Asset Management will call you. We're all across the country, and they can organise an investment meeting to go through the opportunity that you've been presented with today. Now, how am I going to do this? I can see I've just got to expand it. Here we go. Bear with me one sec. I'll just go through a few of the questions that you've asked. What percentage would I call a high capital growth? Look, I think if you can achieve over 10%, that is a high capital growth potential. Warren Buffett, his annual return has been 19.7%, so that gives us a fair margin of safety. Over the last 3 years, it's been just on 10% that he's able to have achieved. So you copy your book? Yeah, that's great. I'm happy for you to send you all a copy of your book. If you need a book, again, put all your details down and we'll send you a copy of your book. I don't understand the contingent coupon. Okay, because Berkshire Hathaway doesn't pay a dividend, what happens is we need it to go up in value. So after 12 months, if it's gone up, let's say 10%, we pay out 10% as income. If it goes up 20%, though, we pay out a maximum of 10.8 to investors. The rest stays in the investment until you redeem. That way, if it goes up in the first year, up in the second year, and the third year it plummets for whatever reason, you've banked a lot of money along the way, which reduces risk and puts money in our back pocket. Series 6, yeah, we've got an investment in Series 6. Someone's pointed out. Series 6, it matures in the next few months. The actual investment, Berkshire Hathaway is up around 38%, but because of our structure, the actual return to investors is up around 110%. So we engineer the investment to give us high capital growth. 110% is their return on their investment and their outlay. So it's a phenomenal return over that period. We have our own super set up already, however not using it. We have the problem I see with self-managed super funds is plenty of people set them up using their accountant, but then they leave it in cash. So it's paramount that you gain advice to help you with that. You know, we've teamed up with a few other industry experts and created a self-managed super fund education company called the SMSF Club. So go to their website, thesmsfclub.com.au. I'm the MD and the founder of that, just to talk about how you can be educated and about the different investment alternatives using your super. To get the loan, we can obviously transfer 10 grand, have no history in super. With the investment to borrow, there is no history. All that you need to do is prepay all the expenses up front. The self-managed super fund or even in your own name can borrow. The capital protection applies all the time these days, which is true, but obviously if you just walk away from the investment prior to maturity, you can lose all of the interest up front. We enter in fixed agreements with the bank, so if you walk away you can lose that interest expense because you're going to break those fixed interest loans. But you can walk away anytime if you like. The $17 million isn't for a put option. It's $170,000 for one share. And when you're buying one put option in the United States or here in Australia now, one put option covers 100 shares. So if you're going to buy 100 shares with one put option that provides protection over those 100 shares, it's $17 million worth of shares in Berkshire Hathaway. But you don't need to worry about all that sort of stuff because we hedge it internally. Yeah, if you can put your phone numbers details in this question section, that'll be tops, just so we can collect those details and get in contact with you as soon as we can. Where are we? What happens if we're not sorted by the 21st of June for the next, so you cannot do it in the next month or so. We trade this financial year, so by the 21st of June, that's when the investment closes. A few days later, the bank direct debits your bank account for the interest expense, all the costs up front, and then we're investing late June. How can an SMSF borrow for this investment? Self-managed super funds can borrow provided strict rules have been met, and that is the loan needs to be paid on a limited recourse basis. There is no special trust that you need or anything like that, provided your self-managed super fund has got the capacity to borrow, which generally these days the majority of them do. Our guys at Secure Asset Management will review your trust deed to ensure that that is the case, and you can borrow under those terms, because the loan is provided on a limited recourse basis, whether it's a self-managed super fund or not. Do we only offer this investment every 3 years? No, we've put together 6, but there's 2 things. One, we want to make sure that the timing is right for us now, certainly with Buffett coming out and announcing that he's willing to buy the shares. It creates a bit of a backstop, so we think the timing to enter the market today is perfect. So if you have missed the last, this person there said missed the last 15 to 20 minutes, by all means tune in at 8 o'clock tonight, and we'll be doing the same sort of thing. It'll be the same webinar. How's it work tax-wise? That's a great question. Look, we're not accountants, and we encourage you to seek independent tax advice. Are you locked in for a certain period? Well, the investment is designed to be held to maturity, which is 3 years, but you could walk away at any time over every 3 months. Thank you. This has been excellent. Great help. I appreciate your efforts. No dramas, Fiona. All good. Copy of your book. Yeah, if you put in your details, that'll be good. How long does it take to set up a self-managed super fund? Well, it can be set up overnight, but to transfer funds across and to be registered with the ATO takes around about 2 or 3 months. So it does take quite a period of time. But you don't need to do it just in your self-managed super fund. You can do it in any name. How much for the book? We'll send it to you for free. Our job is to provide education for nothing, so we provide it to you like today's webinar for free, and then hopefully if you do empower you to take action and invest, then we should be making money in the performance fees at the back end. So we'll give you a copy of the book free of charge. So thanks for tuning in. Again, I encourage everyone to tell all your work colleagues that are sitting around you or wherever you are to tune in tonight. That will be extremely grateful. Put in your phone numbers and we'll give you a contact to organise that free meeting with an investment advisor. Whether or not Berkshire Hathaway is investment or you're set up to decide to take advantage of this investment opportunity in the next week, it's a good opportunity to sit down to have your investments reviewed and to be educated with those coaches around the country. So thanks for tuning in. I hope you learnt a bit about Warren Buffett. If not, I encourage everyone to become an investor, and next year we'll be looking at organising a conference to go over to the annual shareholders meeting, Berkshire Hathaway, to sit down with Bill Gates and Charlie Munger, Warren Buffett, to talk about different investment opportunities around the globe in May next year. So tune in for more. I look forward to helping you guys out in the future. Here's for the next 3 years for Berkshire Hathaway. Thanks very much.